Welcome to Smart Wealth with Joshua, and Merry Christmas to you.
Your daily stock analysis and catalysts talk. Today we're looking at Hycroft mining.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, let's do it. When we look at miners, especially in the exploration phase, it's usually the same story, right? Great potential asset, but a really scary balance sheet.
That's the classic setup. But this one's different.
Yeah.
The story here is it's a massive financial pivot.
A pivot. Okay, so what's the headline? What's the number one thing you need to know about their financials right now?
They're debt-free.
You mean like low debt?
No, I mean zero debt. They have aggressively, and I mean aggressively, cleaned up the entire balance sheet. As of October 16th, it's all gone.
That's huge for a company in their position. So what exactly did they get rid of?
Well, there were two big chunks. First was about $15 million in first-line debt. Gone.
Okay.
But the real monster, the one that was weighing them down, was the $125.5 million in senior secured notes.
And that's gone too.
Wiped out. And what's really interesting is how they did it. They actually managed to repurchase those notes at a 9% discount.
Wow, so they didn't even pay full price to get out from under it.
Exactly. They spent about $110 million to make a $125 million problem just disappear.
Okay, but that kind of money has to come from somewhere. How in the world did a pre-production miner fund a cleanup that massive? That must have involved some significant capital raises.
It did. And you're right. They essentially traded one kind of risk for another. They completely leaned into equity to solve the debt problem.
Dilution risk for bankruptcy risk. A classic trade.
A smart one in this case. They generated $235 million in net cash proceeds.
$235 million?
Yeah. Mostly from equity offerings and warrant exercises. That included a pretty recent raise of about $113 million for 14 million new shares.
So that's the trade-off. You avoid the crisis of debt payments, but you add to the share count. But the upside is they have a massive pile of cash now.
A massive pile of cash.
And since they're debt-free, are they like opening the mine gates, firing up the machines?
No, absolutely not. And that's, a super important point for everyone to understand. Hycroft is still very much in a pre-production phase.
So zero revenue?
Zero revenue, negative profit margins. All of that cash, that entire war chest, is being plowed right back into the ground.
So they're de-risking the asset, turning that cash into proven geology. What's the program look like?
It's ambitious. We're talking about a 14,500-meter drill program for 2025 and 2026. This cash lets them just go for it without, having that debt hanging over every single decision.
Which brings us to the asset itself. Why should we care about this particular piece of dirt? What makes it so special?
Two things: location and scale.
Go on.
The land package is just enormous, over 64,000 acres. And it's in Nevada.
Which is a Tier 1 jurisdiction.
Exactly, Tier 1. That means stable rules, good infrastructure, and proven geology. It just lowers the political risk so much compared to other parts of the world.
Okay, so a safe place to operate. But what are they finding? They've only explored, less than 10% of that land?
Right, and what they're hitting is, it's just a game changer. They're finding these emerging high-grade silver systems. The two names to remember are Vortex and Brimstone.
And the geology reports are saying they're open in all directions.
Yeah, which is basically code for, we have no idea how big this thing is yet, but it looks massive.
All right, this is where it gets really exciting. Let's talk grades, because this is the number that makes the whole story click. What did they hit at Vortex?
The grades they're extraordinary. The reports highlight silver grades up to 1,545 grams per ton.
Okay, wait. For anyone listening who isn't a geology nut, put that in context. What's considered a good grade?
I mean, in many underground mines, hitting 200 or 300 grams per ton is considered high grade and very economical.
So 1545 is?
It's almost unheard of. It's obscene. It completely changes the potential economics of the project. This is the kind of grade that points to a very high-margin, low-cost mine.
That one number explains why investors were willing to stomach the dilution. It screams world-class asset. And there was another intercept too, right? A wide one.
Yes, and this is just as important. They hit 30.8 meters, grading at 438 grams per ton of silver.
So you have the super high-grade veins, and you also have these wide, still very high-grade zones.
That's the bull case right there, grade and scale.
So asset quality is clearly there. How did the market react when the debt news dropped?
The reaction was pretty immediate. The shares jumped 4.9% right after the announcement.
And technically, what's the chart telling us?
It's constructive. The stock is forming higher lows, which is a classic sign of accumulation. Bigger players are building a position quietly.
I also saw a note about a potential, what was it, a golden cross?
Yeah, that's a big one for the technical traders. A golden cross is when the faster 50-day moving average crosses up and over the slower 200-day moving average.
And in plain English, that means?
It means the recent positive momentum is starting to pull the long-term trend up with it. It suggests a real structural shift in how the market sees the stock now that the debt is gone.
Technicals are one thing, but the real proof is who's writing the checks. Who is the smart money here?
The name you have to know is Eric Sprott.
A legend in the precious metal space.
An absolute legend.
Yeah.
And he has been buying, and buying aggressively. We're talking cluster buys.
Right.
He bought 2.34 million shares for $24 million.
Okay.
And then separately, another 7.7 million shares for around $50 million.
So that's almost $75 million from one of the most respected investors in the sector.
That's conviction. And when you look at the ownership base after all those offerings, it's really consolidated.
How much do institutions own now?
It's sitting at around 80%.
80%.
Which means most of the shares are in strong, patient hands that understand this is an exploration and development story.
Let me push back on that for a second, though. If institutions hold 80%, doesn't that make the float super thin?
That's a great question. Yes, it does.
So while it protects from retail panic selling, it could also mean any real news, good or bad, sends this thing flying, right? It could get really volatile.
It absolutely introduces liquidity risk and volatility. The swings could be huge. But it also means that on positive news, with so few shares available to trade, it can really catch fire.
We should mention the one bearish data point. There was a director sale, wasn't there?
There was, yes. Director Marnie Weishofer sold about 3,800 shares for around $51,000.
Is that significant?
Any insider sale in a zero revenue company is something to note. But she still holds over 70,000 shares. And when you weigh that $50,000 sale against Sprott's $75 million buy, it's a footnote.
Just noise.
It's just noise. The money flow is overwhelmingly bullish.
Okay, so looking ahead, what moves the needle from here? What are the near-term catalysts?
It's all about the drill bit. That's catalyst number one. The results from the ongoing 2025-2026 drill program at Vortex and Brimstone.
And they're still drilling now.
They are. 2 rigs are turning right now, and they plan to add 2 more in 2026. Every press release with high grades de-risks the story further.
What else is on the calendar?
There's the annual meeting of stockholders on December 29th. Usually not a huge deal, but for a turnaround story like this, any commentary on future strategy or timelines could be very important.
And then there's the macro picture, the price of silver itself.
For sure. That's a major tailwind right now. Silver has that dual benefit, right? It's a precious metal, so it likes the idea of rate cuts.
But it's also a critical industrial metal.
Exactly. For solar, for electronics, that demand is strong. So you have a favorable macro setup for the commodity they're finding in the ground.
It all connects. But we have to talk about the new risks. They swap debt for dilution. What are the big vulnerabilities now?
Well, number one is that dilution risk itself. The recent offering was necessary, but it did add 14 million shares. Investors have to be aware that future development,
building the actual mine.
Right. That could require more capital and potentially more shares being issued down the line.
And the second risk has to be execution, right? They've done the financial part, but they still have to, build a mine.
That's it. Execution risk is still very, very high. They're an exploration company today. The timeline to actually restart operations, to get permits, to build everything, that's all still speculative. There's no confirmed date.
So to wrap this all up, we have a company that's now debt-free with a huge cash pile. They're funding a drill program that's hitting world-class, almost unbelievable silver grades.
And it's all being backed by serious institutional money, led by one of the biggest names in the business.
It has all the makings of a potential multi-bagger and it's a big if they can execute.
Concluding thought. The target horizon for this narrative turning into production reality is generally viewed as a swing trade into the 2026 drill results, roughly 3 to 6 months. It's a high-conviction, high-risk exploration story anchored by significant debt reduction.
Remember to subscribe, like, and comment to support Smart Wealth with Joshua, and we'll catch you on the next analysis. Merry Christmas again.